Good afternoon, everyone. Really want to thank you all for being here. I'm looking forward to this conversation. Today, we're going to talk about something that I think in the investing world just does not get as much attention as it probably should, and that's taxes. When most people are looking at their taxable portfolios, we're looking at returns, focusing on percentages, we're comparing performances. But I think the important thing about this discussion today is it's not just what you earn, it is what you keep. And those of us out there that are taxable investors, taxes are a real and constant drag. Short-term gains are taxed at really high rates. Long-term gains, of course, matter. We have federal taxes, we have state taxes, we have net investment income tax. And that gap between pre-tax and after-tax returns can be really significant. And this is key because that drag it compounds. Every dollar that you pay in taxes is a dollar that's no longer working for you. And over 10, 15, 20 years, it makes a really big difference. Now, historically, we've had tax loss harvesting, but that's largely been very reactive. You wait for a market to drop, you harvest losses when you can, but after long periods of time, many long-term portfolios, they simply run out of losses that they're able to harvest. But today, we've got some technology that allows us to be much more intentional about managing taxes. There's a lot better data, there's better models, there's the ability for daily optimization. We can manage taxes in a much more thoughtful way. And that's why I'm really excited to have Eric with me today. This is Eric Bloom. He's the managing director over at Quantinno. And Quantino's entire focus is helping taxable investors improve after-tax outcomes. We're not just talking about returns, we're talking about really maintaining a lot of after-tax wealth. So today we're going to talk about how this strategy works, how it can generate very consistent tax benefits, and how it can also help investors that might have large concentrated positions or deeply embedded gains. Also, before we get started, I want everyone to know that we will have some time for Q&A at the end. As questions come up, please, you've got a chat box there in the bottom of your Zoom screen. Drop them in there. We'll address as many of them as we can when we get done. But in the meantime, just want to say, Eric, thank you for being here. So let's get started with this. So first of all, I guess first big question is, what is Quantinno and how did you get here?
Yeah, it's a good place to start. And thank you everyone for joining today. And thanks, Brent, for hosting. So a little bit about Quantino, and I believe I can share my screen here just to give you some background as well. So as a firm today, we manage a little bit north of 40 billion, closer to $45 billion in assets across close to 9,000 or so individual managed account. I think importantly there, every single dollar that we manage is on behalf of taxable clients, and that is very much by design. So going back to the creation of Quantinno, which stands for Quantitative Innovation, we launched as a firm in 2018, specifically with the goal of solving the pain points of taxable clients. Our founder, Hoon Kim, he was a portfolio manager, head of global stock selection strategies at a firm called AQR, which was managing north of $100 billion in assets. At AQR, Hoon was managing portfolios for both institutional clients as well as taxable clients. Hoon specifically has this unique background in which he not only has been running multi-billion dollar long short equity portfolios, but he also has a PhD in accounting. So what he would always say is that, he wasn't allergic to tax. So whenever a client would come to AQR and have a question about how the tax impact of the trades that are happening in their specific portfolio would oftentimes fall on Hoon's plate. So in the mid 2010s or so, Hoon was responsible for developing what we would consider the first after-tax portfolio optimization engine. And in layman's terms, what that means is how can we seek to deliver positive pre-tax returns, but also consider the tax consequences of every single trade. So Hoon was very much a pioneer within this tax loss harvesting space. Tax loss harvesting itself, which we can compare this to shortly, has been around since the 1990s or so. You might have heard of firms called Parametric or Aperio that were innovators within this space. We consider what we do here at Quantino to be the next evolution in that, and that we're doing it in both longs and shorts. And so we initially were created as a hedge fund firm in 2018 and then pivoted today to what's called the Deals Managed Account Platform in 2021. We love acronyms here at Quantino. DEAL stands for Direct Equity Active Long Short. And so importantly here, because this is a managed account implementation, we execute our strategy directly within your individual account. So you're not subscribing to a hedge fund. You maintain full transparency, ownership, access, liquidity on a daily basis. So I'll pause there, but that is a little bit of the background of the firm and how we got here today. And I'll also just say that one more thing, I guess, before I pause, is that this space has grown very quickly, right? We've launched this in 2021. At the end of 2025 or 2024, we were closer to 9 to $10 billion in assets. So what we saw over the past 12 to 18 months is about $30 billion in growth, which is obviously quite exciting, but also speaks to how investors, taxable investors specifically, have latched on to these strategies.
Eric, I want to take us back a little bit in terms of you mentioned, tax loss harvesting, traditional tax loss harvesting. I think what you're referring to with, parametric and some of those other firms is direct indexing. But I want to sort of take our listeners here on the evolution from tax loss harvesting that was done just by individuals even prior to that. And what we mean is basically selling securities that have lost value, using those gains to offset, using those losses to offset other gains or potentially stacking those losses moving forward. Then we got something called direct indexing in the 1990s, which I would argue became a lot more mainstream, say in the 2010s. Talk to me a little bit about that strategy before we dive into what Quantinno does very differently.
Yeah, absolutely. So, what you can think about in a long only tax loss harvesting strategy is, let's say you invest $1 million in cash, and with that $1 million, the manager goes and buys single name stocks that track the S&P or the Russell 1000. So, at the end of the day, let's say you own about 400 stocks tracking an index. What the manager would seek to do there is hold on to stocks that have gone up in value, sell out of stocks that lose in value. So the very common example is, Coke and Pepsi. Let's say you own Coke, Coke drops in value, you'd sell out of that position, harvest a loss or realize a loss, and then replace it with Pepsi. What that will allow you to do is maintain same economic exposure, but along the way, generate capital losses as they become available. There is an issue with long only tax loss harvesting, in that portfolios do become stuck. And this is one of the main pain points that Quantino helps solve. The reason why a portfolio might become stuck is that over time, equity markets are going to appreciate, right? 70 to 80% of years, you do find the equity markets growing. So if you bought 400 stocks, 500 stocks 6, 7 years ago, all of those equities have embedded gains or they've appreciated over time. So your ability to harvest any capital losses goes away. So that's what's called being stuck or ossified, and is a very common problem within the direct indexing or tax loss harvesting portfolios that we see today.
Yeah, to add to that, that's a little more color on direct indexing. You look at a year like 2019, for example, arguably one of the lowest volatility years that we ever had in the S&P 500. I think the biggest drawdown was 3 or 4%. But what you had below the surface was you had 80% of the companies in the S&P 500 at some point had 20% declines. And so a traditional strategy like direct indexing was using those moves that were happening sort of under the surface there to take advantage of that. But to your point, Eric, the problem that you have in that over time is that initial squeeze that you get there essentially runs out. And it can be very effective, not as effective as what you're doing, but it can be pretty effective in those early years. But then you've got, as you put it, these ossified portfolios where pretty much everything that you're owning now has pretty big gains. And so you're kind of stuck now. You're stuck just owning something that tracking error might be limited, but it looks a lot like the index. So talk to me now take me down the next evolution of that in terms of where Quantino is and what you're doing to address that.
Yeah, absolutely. So I would say this is our most common problem that clients come to us with, and there are other ones that we can help solve and that we'll talk about today. But we have this slide right here because it is a very common pain point. So let's say client has $100 tracking the S&P 500 that was in a traditional tax loss harvesting portfolio. That's this dark green here. How Quantino works is that $100 continues to sit in your account as it stands today. Quantino gets assigned as the sub-advisor on the portfolio, and we use the borrowing power of your $100 to add what we call long-short extensions. So in this case, we add $30 long, $30 short. In total, it's a 130/30 portfolio. Importantly, there, we are using a little bit of leverage and we are using shorting, and we can talk about what that means. But these are important tools in the toolkit, and candidly, tools that a lot of taxable investors haven't used before Quantino came into the market. But given our experience managing long-short equity portfolios, if we do a modest amount of leverage, if we create diversified short portfolios, when used appropriately, we can meaningfully impact a client's portfolio. So, in the $30 long extension and in the $30 short extension, we own US large and mid cap single name stocks. So, nothing exotic in terms of options, derivatives, or anything like that. If you own, let's call it 400 stocks today, when we put on the long short extensions, you might now have 550 stocks long. So, we've added about 150 stocks to your long portfolio. And then we'll add about 150 to 200 individual short positions as well. The key benefit of adding these long short extensions is that all these positions that we've added to the portfolio have fresh basis. So now we can harvest capital losses regardless of what's happening in the market. And just to break that down a little bit, this $100 portfolio that you came to us with, you can't harvest any losses on, right? All the positions you own have embedded gains. Now we have fresh basis positions. So if the market goes up, we can harvest losses in the short book. When the market goes up, short positions are at a loss. So what we'll do is hold on to winners in the long 30, sell out of losers in the short 30, and we're able to realize capital losses for you while still giving you index-like exposure. If the market goes down, it's just the opposite, right? We hold on to positions in the short book, sell out of losers in the long book. So regardless of market directionality, we're harvesting very consistent, significant capital losses. And I like to use this chart to actually quantify that benefit. So what we're doing is showing a difference between a long-only tax loss harvesting strategy and a 130/30 strategy. The long-only strategy is going to be that light blue bar, that traditional tax loss harvesting portfolio. In years one and two, you're able to generate capital losses, right? The positions that you own may not have a lot of embedded gains. But again, as the equity markets grow, your ability to harvest capital losses goes away. So by year five, year six or so, you're stuck. With a Quantino portfolio, you are able to harvest significantly more losses in early years, effectively double the amount of capital losses, and we're able to extend that tail out further, right? If we assume the equity markets continue to grow into later years, we continuously turn over the short book, generating capital losses, and that embeddedness does not necessarily prevent us from still generating losses.
And what you're solving for here, Eric, is obviously on the front end of this thing, you've got you mentioned an ossified portfolio. So a portfolio where we don't have there's not a lot here that we can sell. Those new 30% long positions that you're adding on there, by the very nature of the equity markets, some of those are going to go down. So that's going to create an opportunity to capture some losses. And over the years where markets consistently, as you put to your point, 7 out of maybe 8, 10 years or so, the markets are heading higher, you're getting the opportunity to lose money in those short positions every single year. So that's creating that excess ability to capture those losses. Is that kind of a good way to put it?
Yeah,
Now,
that's
do
exactly right.
you have an issue like what we're looking at here in the chart with the amount that you can actually harvest in any given year going down? Is that basically because your 30% long leverage itself becomes ossified?
That's exactly right. So importantly, we are not immune to the idea that equity markets are going to grow over time. So if that does happen, our long portfolio, right, we're still holding on to winners, selling out of losers. Again, if the equity markets grow, we're going to have to hold on to winners in that long 30 portfolio. And so we get embeddedness as well. So our ability to harvest any capital losses from the long extension depletes. Really, what you're seeing in these later years, years six and beyond, is purely just capital loss generation coming from the short portfolio, right? As the equity markets grow, our shorts are still at a loss. We can turn over that portfolio a lot more frequently, avoid any embeddedness or getting stuck there.
Now, you also mentioned you're using leverage to do this. Leverage costs money. You can't go and borrow money for free. Give me an idea what the leverage costs within the portfolio.
Yeah. So how this works, and we have the leverage cost here is a little bit different than what you would maybe think of a normal borrowing cost. So for our portfolios, and I'll actually flip to this slide, we don't have to get too in the weeds, but I think it's worth understanding, is that let's take this 130/30 portfolio again. For the long extension, you pay a rate of, let's call it Fed funds plus 50 basis points. For the short portfolio, you're collecting Fed funds minus 50 basis points. So what you pay in Fed funds is what you receive. So you don't have any interest rate exposure, but you are left with some financing spread. So if we do a 30/30 implementation, what you're left paying is 30 basis points cost of financing. And this is interest expense that might be tax deductible. So to get access to leverage in this portfolio, it's not that 6, 7% that you might be thinking that's out there today. It's a lot more palatable of a cost, right? It's 30 basis points, and that would be $3,000 on a $1 million account.
So to make it simplistic, on the long side, the excess juice you're getting on the long side, you are the borrower. On the short side, you're the lender. And so regardless of what rates are doing behind the scenes, it kind of balances it out mostly.
Exactly.
Okay. Let's talk about another use case that you have for this strategy. Let's say a client came to you and they've got $20 million taxable account that's been in play for 30, 35 years or something, and the basis on this account might be 3, 4, $5 million. What do you, and everything in here, there's really no room to sell anything for a loss, to either diversify out of some of those positions, maybe freshen up the portfolio a little bit. What can you do in a situation like that?
Yeah, absolutely. So just to set the stage and put some nomenclature to the different options that we have, what we've been discussing in taking over a long-only tax loss harvesting portfolio is what is called our deals core strategy. Again, the idea here is to continue to give you index-like exposure relative to the S&P, Russell 1, Russell 3, whatever index of your choosing, while generating capital losses for you. And those capital losses are free and clear for you to utilize how you see fit. But as Brent alluded to, we do have another use case, which is called our deals exchange strategy. Exchange is specifically designed for concentrated stock or concentrated portfolio diversification. So a lot of portfolios that we see today, client has bought Nvidia, Amazon, Apple, and over the past 10, 15, 20 years, that portfolio has grown from maybe $1 million to $20 million, and it has a very low cost basis. It's dominated the risk within the client's portfolio, but the client doesn't want to sell out of it and realize this massive capital gain. So how can we use the capital losses or Quantinno's capital loss generation ability to diversify in a tax efficient manner? That's what's called our deals exchange strategy. So diving in a little bit to what we can do here. Let's say client has $10 million of NVIDIA stock. Upon Quantinno getting assigned as the sub-advisor, we'll do the same 30/30 implementation. We'll add $3 million long, $3 million short. Again, these portfolios made up of large cap, mid cap, single name equities. Every single month, we'll actively tax loss harvest within these long short extensions. And let's say at the end of February, we say, okay, we have $100,000 in capital losses by way of trading the extensions. With that $100,000 in capital losses, we can then sell out of NVIDIA, realizing $100,000 in capital gains. So it's a like for like, or I would say any dollar in capital gains that we realize is paired with a dollar, or sorry, capital losses we realize is paired with a capital gain coming from selling out of the concentrated position. That results in a tax neutral sale. Then, with the proceeds from the sale of the concentrated position, we buy more stocks that look like the index of your choosing. So you'll see this concentration of NVIDIA go from 10 million down to 9 million at the end of year one. Your diversified equity portfolio has grown from 3 million to 4 million. And so this happens every single month, all within your managed account. So here's an example. If we do a 30/30 implementation on a 1% cost basis position, we tax neutrally move the portfolio from 100% concentration to 100% diversified. So by the end of year 8, what you own is a couple hundred stocks tracking the index of your choosing.
Yeah, I think that's a really important point to bring up too, because there's a lot of emotional connection that people can have to a position that's been well to them, like Nvidia has been for sure for a lot of people over the last few years. But you would know the math better than me on this, Eric. I think, was it like 85% of companies are going to experience some kind of significant loss over a 20-year hold. You think of the General Motors in the world, the WorldComs rather, and the Enrons and companies that have blown up in the past. And that ability to diversify out of these extremely low basis or no basis positions over time is a really powerful thing. Now let's say flip side of that, another use case. You've got existing portfolio. It's already fairly broadly diversified, so the client is generally getting what they want out of that. But we work with a lot of business owners, and so perhaps there's a sale of business coming in a horizon 4 or 5, 7, 8 years down the road. Talk about the power of stacking those capital losses in advance of a big
Yeah.
long-term capital gains event like that.
Yeah, absolutely. So, taking over long only tax loss harvesting, great. We can just generate losses as you see fit. Exchange, we can help diversify. The business sale use case is also a big one for us. So when you bring to us that portfolio that maybe has some embedded gains, we generate these capital losses for you. The capital losses that we're creating, I'll give you a sense of what those estimates are. So on a 30 by 30 portfolio, even if you come to us with a highly appreciated account, we can generate about 11% of account value in capital losses. So on a $10 million portfolio, that means we can generate $1 million in capital losses in year one. Year two, 700,000, year three, 600,000, you still get that depletion. But at higher leverage levels, and we can talk about the trade-offs between leverages, but at higher leverage levels, you can generate significantly more in capital losses. So here's the idea where if you're planning for a business sale or if you're planning for the sale of a home or any asset really, and you have visibility into what that is going to be 3, 4, 5 years down the road, it's hard to do a lot in terms of capital loss harvesting in just a single year. There is a huge benefit to getting going on this earlier, right? The longer that we have in the market, the more loss harvesting opportunities that we have, and the better that you can plan for that future sale. So, for example, at a 75 by 75 implementation, we can harvest north of 50% of invested capital in capital losses ahead of that business sale activity. So when it comes to sell that business, let's say you've invested $10 million with us, we've generated $5 million in losses. We can make a significant dent in that capital gain as a result of the transaction. So this is huge for capital gain planning down the road. We have other clients who come to us post-sale, right? You've sold the business, you haven't done any capital loss harvesting ahead of then. We can take the proceeds from the sale of the business and put those to work as well. And we can kind of play catch up rather than prepare in advance. Still, both very good use cases to help defer any capital gains as far into the future as you would like.
And tell me, in terms of the underlying portfolios, do you have the ability? We talked about U.S. stocks here today, but can we tailor this towards international markets and something outside of the Russell or the S&P?
Yes, highly customizable. And part of Quantinno's value add is that we've designed our systems to be 100% focused on taxable clients, and we recognize the pain points of taxable clients are varied, not only in the use cases, but everything to as granular as the benchmarks that you want to track. So we can do domestic S&P, Russell 1, Russell 3. We can do international. That means like MSCI World, MSCI ACWI. We can do blends of US and international. So you really have a bunch of different levers that you can pull so that we can fit your overall portfolio allocation as best as we can.
Now, talk to me about what happens in the basis of these portfolios. I mean, is it possible to go to negative basis?
Yes, it's a little bit of a tricky concept, but it is a managed account structure. And so what that means is you technically can deplete your basis below zero. So if you come to us with $10 million, we can actually generate over X amount of years more than $10 million in losses. And I'll just clarify, and we can get into this as well, is that when it does come to unwind out of the
That was my
portfolio,
next question, Eric.
yeah, you come to us and say, hey, Quantino, I no longer need you. And that's totally fine, right? We can do this T plus one. What that means, though, is that we'll have to sell out of the extensions. And in selling out of these extensions, right, we've held on to unrealized gains primarily in the long book. We turn over the short book, so there's not a lot of embedded gains there. But in shrinking the long extension, you're going to incur some tax consequence. So typically, we see clients come to us, say, hey, Quantino, I want to unwind out of the portfolio. And what we'll do, T plus one, I think I have a slide here. Yep. T plus one will just peel off these extensions and you will incur a tax consequence as a result of that unwind.
which is going to be
Another,
highly dependent on what those extensions look like.
exactly. Yes. But I think the important thing to note here is that, this is capital gain deferral. We're not necessarily eliminating taxes for you, but we can kick them down the road as far as you want. And we hand you back this core asset to you, and you can do with it as you see fit. That would be a T plus one unwind. We do also have the ability to spread out that tax cost over multiple years. So if you want to go from 130/30 down to 120/20, 110/10, et cetera, and so you don't have this kind of lumpy tax bill in one year, we can slowly do that over time as well.
What happens to the basis if and when somebody dies?
So this would be the most tax efficient way to exit the strategy, right? Because the long extension is going to be the one that primarily holds on to the unrealized embedded gains. Upon death, the step up event, you would get a step up in basis on the full long 130. So all of those positions you own, even the ones we own on margin, receive a step up in basis. The short book is technically a liability, so that does not receive a step up in basis. That gets unwound, but you wouldn't probably see a lot of tax consequence as a result of shrinking the short extension.
What happens if it's in a trust that's not tied to the life of any one person?
A little bit nuanced. I think it ultimately depend on the client's specific situation, or the structure of the trust. I don't have a great answer for you there, to be honest, Brent. But essentially, the beneficiary of the trust can continue to run the strategy if they would like.
Got it. So essentially, what would happen is the basis, obviously, because it's not tied to anyone's life, it's just going to continue on in the trust sort of indefinitely.
Correct.
Got it. Got it. What are some other use cases that you see for the strategy besides something that what we've talked about here?
Yeah. So taking over long only tax loss harvesting, diversifying out of concentrated stock, preparing for a liquidity event, all very relevant use cases. I'll speak to one more that we see, which is called our deals overlay strategy. And just to go back to this page to frame what it is, comparing it. Yeah, with deals core, we're managing the full 130/30 towards an index. Deals exchange, we're diversifying out of a concentrated stock. With overlay, you can come to us with an ETF. Maybe you have SPY or VOO, or maybe you have 10 stocks that you really like and you don't want to diversify out of them. You can still fund an account with those positions. We'll take over those positions in kind. We put the long short extensions around them, and we won't touch the positions that you bring to us. We'll strictly trade within the extension. So rather than the full 130/30 like we would in core, it's just the 30/30. And what this allows us to do is make your existing portfolio more tax efficient, right? If you've just held SPY for the past 10 years, it's an idle asset, which is fine. There's nothing wrong with owning SPY, but we can generate capital losses around it by way of putting on these extensions. And those capital losses that we're creating are free and clear for you to utilize. And so if you want to rebalance your portfolio from maybe 80/20 equities fixed income to 80, 10/10 and move into alternatives, that's going to incur some capital gains, but we've created these capital losses for you to help make that portfolio transition a little bit more tax efficient.
Got it. Another question. I'm going to wave my arm around here because my light automatically goes off. Yeah, there we go. It drives me crazy. Anyway, another question I have for you. Who do you think, obviously in the direct indexing space, it's getting really, really crowded. There's a lot of players in there. Who do you view as your main competitors with this kind of strategy?
Yeah, um, I think what we're seeing is a lot of long only tax loss harvesting providers now try and get into this space. So by name, we said like Parametric and Aperio, those big long only providers that have been around since 20 plus years, have lost a lot of assets to long short, so naturally they're launching their own. Our former firm, right where Hoon came from, I worked there as well, AQR, also has a similar product. I think what you'll find in looking at Quantino versus them is that AQR was a hedge fund and mutual type fund or firm now trying to do long short managed accounts. Long only tax loss harvesting providers are now trying to do long short. Managing leverage and shorting is not necessarily a skill set that you develop overnight. we think that we've uniquely positioned ourselves as having that hedge fund type pedigree, but also building a firm that's specifically focused on taxable clients and managed accounts. And so all those customization options that I mentioned, all of these use cases like exchange and overlay are pretty unique to what Quantino can do. So you'll find our platform is one where we meet end clients or investors where they are, rather than having asking you to fit into a specific box that is a product.
Okay. Now you mentioned a few. It's my final question for you, but I definitely want to cover anything else that you think is relevant. Because this is what you're doing, pretty much only you're dealing with only taxable accounts. How important is first that focus, but also the technology that you employ to execute on this? Is the technology that you guys have, is it unique to Quantino? Do you want to discuss a little bit more about how you're doing that?
Yeah, absolutely. So what we call it is our tax edge technology platform. And I think the natural question that we always get, so Quantino, we manage about 50 or $45 billion dollars, and we have about 60 people. So it's not some massive organization, but we think we are quite lean and nimble for a reason. And a lot of that is we are a modern asset manager that relies on technology. So we manage north of 9,000 accounts. Every single account looks a little bit different, right? Different benchmark, different leverage, different trading restriction, different end goal. So we need to be able to have the technology to monitor all of those accounts and launch all of those accounts at scale. So when we go to monitor portfolios on a daily basis, we've built out a system where we ensure that we're maintaining proper leverage. If an account gets slightly over levered or slightly under levered relative to our target, it flags within our systems and we can rebalance to get you back to what the desired outcome would be. And then when we go to rebalance a portfolio, it's very much an integrated decision or an optimization across multiple factors. So we implement an alpha model determining why we're long stock A and short stock B. We understand, your portfolio, what benchmark are you trying to achieve? What's the risk? What's the correlation between that benchmark and maybe other assets that we own or are managing against? What are the financing costs, the trading costs? What are the investment constraints? Are there ESG restrictions? And what are the tax consequences of every trade that we make? So when we go to rebalance a portfolio and we rebalance a couple hundred every single day, we are trying to solve a puzzle that considers all of these. This optimization is something that we have developed in-house, again, with that sole focus on taxable clients. A lot of firms might have these first four, right? But that tax loss harvesting piece, being able to consider the trades, not only from an alpha model view, but also a tax loss harvesting perspective, is incredibly important. So all of this gets processed within our optimization engine, and then we go out and trade with the custodian, and we trade every 30 days so you can ensure that you are getting a tax loss harvesting benefit as well as hopefully some pre-tax outperformance every single month.
Great. Now, I think this is a meaningful discuss. I know it's a meaningful discussion today because there's very few things that we can control. We can't control necessarily directionally what the markets are going to do. In the past, we haven't had the flexibility to control the tax consequences of the investments as we do today. Obviously, we talked about traditional tax loss harvesting, and that's one step. But when we talk about these losses, I really want to equate that in actual cash flow because if you're at those top marginal rates that ability to write off significant amounts while still having an underlying asset that's tracking the general upward trajectory of the markets is just incredibly powerful. With that, any final thoughts on that, Eric, before we open it up to any Q&A?
Yeah, I mean, I think let's talk about live performance, right? And
Yeah.
ground that in what we've actually done and the dollars that we've saved for investors. So what we're showing here is if you gave us $1 million in March of 2021 when we launched this platform, let's say you gave us $1 million in cash and told us to go track the S&P, what would we have delivered? So since inception, cumulatively, we've returned about 105.5% net of fees. The S&P's done about 95%. So we've outperformed the index net of fees by 10% cumulatively. So you get pretty consistent, significant pre-tax outperformance, about 1.5 to 2% per year. This comes along with about 4% tax alpha. So from an after-tax perspective, the worst year that we had was, beating the index by 3.1. The best year was we beat the index by 8% after tax. And there's a couple things worth noting here before diving into that actual tax benefit number is that the loss harvesting that we've executed, right, the 4% per year, again, regardless of market direction, years like 21, 23, 24, even 25, all years in which the market was up 20 plus percent. A long only tax loss harvesting strategy would have a very hard time harvesting any losses in those periods. For us, because of that short book that we've introduced, we've been able to deliver those losses. And then you look at a year like 2022, in which the market was down, we still delivered consistent losses in line with what we did in other years, and we actually beat the index on a pre-tax performance basis. So multiple market environments, we've been able to deliver on exactly our goals.
Awesome.
And then on the tax benefit, just to put a bow on it, how we come up with that number is, again, this $1 million portfolio has grown over time. Let's say in 2025, this portfolio was at $2 million. Throughout 2025, we harvested about $300,000 in capital losses, or 14% of account value. 2025, a pretty good year for loss harvesting. There was a lot of cross-sectional volatility. You look at a month like April 2025 around Liberation Day. That was a good period for tax loss harvesting. So we actually saw a little bit of an uptick relative to our long-term estimates of around 10%. But we harvested close to 15% of account value in capital losses. If we assume these capital losses offset capital gains at the short-term rate, 40.8%, so we multiply 14, 15% by 40.8%, that yields that 6% tax savings number that we show here. So this is 6% tax savings back in your pocket that you can reinvest and allocate as you see fit. So that's really the power of the strategy, right? You have a fee, the financing fee, a management fee, but we're seeking to cover that with any pre-tax outperformance. And then the tax benefit that we're creating every single year is just gravy on top of that.
Well, thank you, Eric. Now, again, what we're talking about here, I know we're talking about very complex products. We're talking about using leverage. We're talking about a lot of different issues around taxes for sure. And what I would definitely suggest to anyone that's listening to this, because I can understand aversion perhaps to when ask a few questions about this. Eric has been kind enough to be on client calls with us in the past. If this is something that you'd like to dive in deeper into, please let anyone on our team here at the Wealth Stewards know, and we can set up that opportunity to have a deeper dive. But where I think the application really makes sense, again, to put my own bow on this, it would be, business owners that we're working with that are potentially looking at a very large, significant capital gains event a few years down the road. The ability to stack these losses on the front end are real dollars in your pocket. If you've got large concentrated equity positions that you need to peel back because they might have done exceptionally well and there's just quite frankly too much risk in the portfolios, and you want to do it in a way that's not going to blow yourself up when that tax bill comes, this is an excellent strategy. If you've got, I love the term ossified, Eric. I think that's a good one. But if you've got a ossified portfolio, whether it was via direct indexing or just a number of positions you've held for a very long period of time, I view these losses as cash flow because at the end of this whole thing, when you are paying your taxes, that tax loss that you can apply can be significant cash flow in the future, depending on what your own personal situation looks like. So again, I'll open up real briefly to questions. This one was a deep one. We're talking taxes, we're talking about leverage, we're talking about a lot of other things. So I can definitely understand maybe not as much of a desire to dive in with questions right now, but I really want to encourage anyone, if this is something that's piqued your interest, if it's something you want to talk about at a much deeper level. Eric's a fantastic friend to us here, and he's a great resource for us as well. But this is a strategy that we found has been really, really powerful when implemented in the right specific circumstances. So with that, I'll give it one more shot for any questions. With that in mind, Eric, you're super busy. Really appreciate all the time you spend with our team here and also the time you spent today. And I think this is a really excellent summary of what this is, how it is very different than, I mean, so these are very new strategies, but they've been employed really successfully now through some very, oh wait, we do have questions. Sorry, guys. I did not see.
Yeah, yeah, I can see a couple in the Q&A box here as well. I'm happy to tick through them.
Yeah, I saw Chris Petty. Thank you for that. Yeah, if you could, I'm
Yeah.
not seeing any questions. So Eric, yeah,
Yeah,
you can
yeah,
dive
I
in.
can see them. I'll tick through them. So the first one, have there been any tax opinions supporting the 130/30 portfolio? Any IRS challenges? What is the tax risk? Good question. So we do have a tax opinion from our legal counsel, Seward and Kissel. Essentially, what the IRS states is that there needs to be an economic substance or economic motive behind these strategies. And you saw that with the pre-tax outperformance that we exhibit on an annual basis, right? There is a decision to why we're long stock A and short stock B. So we have that economic motive. We have a tax opinion, which we can share with you that grounds these strategies in economic substance, which is not necessarily pushing the envelope in terms of like tax arbitrage, right? We're holding on to winning stocks, selling out of losing stocks. If there is an economic reason for doing that, then we feel covered. And we manage 9,000 accounts, have been doing so for 5+ years. We don't always have specific insight into audits that our clients receive, but I can say from our perspective, we have never seen a red flag get raised by the IRS that's been brought to our attention.
And Eric, I'd add to that too that we've had a number of CPAs here that we work with locally that have also done a lot of their own due diligence and are totally comfortable with the strategy.
Yeah. Next question was what are the non-tax or market risks to the 130/30 portfolio? So I think about um, two sources of risk. One is going to be that tracking error, right? That 1.5% T that we have for a 130/30 portfolio. So if the S&P goes up 10% in a given year, ideally we outperform. We have since inception, but there is potential underperformance risk. So that pre-tax risk, like I think you saw in one of those years, we underperformed by about 80 basis points or so. That's a real practical risk here. Another risk would be margin call risk, right? We are using a little bit of leverage for these portfolios. Importantly, it's a modest amount of leverage. So quantitatively speaking, the asset that you fund the account with would need to drop by 60 to 70% in a single day in order for there to be a margin call. We've not come close to a margin call. Obviously, that risk gets a little bit higher with a single concentrated stock position versus a diversified equity portfolio. So on a diversified equity portfolio, we might be able to offer higher leverage than we would on a single concentrated position, but we always want to use modest, thoughtful amount of leverage so that that worst case scenario is really what would need to happen in order for there to be a margin call. Another question was average account size. So 5 million roughly is what we have today, but we manage accounts as low as $1 million going up to $500 million. We really see it, between everyone. What I will say is like, the best use case for this client. I think, as Brent mentioned, it's someone who has a capital gain need, right? They're either selling a business, they're selling a home, they want to reallocate their portfolio from equities to fixed income, they want to diversify out of a concentrated stock. These losses are only really benefit or generate that cash flow if they're offsetting a capital gain.
Correct.
So,
Yeah.
we can still give you 130/30 and generate all these losses, but the client is really going to see a benefit if there is a capital gain that they need to offset. So it's more geared towards that tax sensitive kind of not ultra high net worth, but I would say high net worth and above type client.
And I was able to get into the Q&A here again. Chris, thank you for thank you for alerting me that there were some questions here. We also got management fees. So Eric, we talked a little bit about what the financing charges were on this. Gross about 30 basis points, net probably 18 because some of that is deductible.
Yeah.
What about the management fee aside from getting access to the leverage?
Yeah. So the management fee is 32.5 basis points. And that's charged on the account equity value. So if you fund with $1 million, it's charged on the 1 million, not the 1.6 gross exposure.
And
So all in, yeah, go ahead. Sorry.
yeah, and I'd add to that too. When we consider the cost of that for what you guys are doing, you've got basic bread and butter small cap stock funds out there that are in excess of 1.5% in terms of some of those management fees. So the cost, given the complexity of what you're doing and the technology you're employing, it's a cheap mutual fund, really when it comes down to it, which is pretty incredible. Any other questions? Well, I really want to thank everybody for your time. You've been with us today for 45 minutes. Eric, as always, thank you for the work that you do for us. This has raised any questions either for yourself or for people that you care about. We think it's an excellent strategy. We think there's a lot of good reasons why this can make sense. Please reach out again to anyone here on our team, and we'd be happy to dive in a little bit deeper to cover how this might work for you in your own personal circumstances. But with that, you're not seeing any questions that I am not, correct, Eric? We're good?
Yeah, got them all covered.
And we will also have a recording for this that we'll be sending out to everyone. And to those of you that attended, really appreciate you being here and spending time with us. And Eric, as always, thank you for your help.
Yeah. Thank you, everyone.
Take care, everybody.